In F3, you look at the preparation of various different financial statements. You look in detail about what you need to do to prepare them. Now, don't worry if you are watching this and you haven't done F3 yet. This is not really about how you prepare them, it's about why you prepare them. What's the point of them? So the big three things that we're going to look at. We're going to look at the income statement, we're going to look at the cash flow statement, we're going to look at the statement of financial position. So what in general is in each of these things? The income statement basically shows you sources of revenue. Where have we got our revenue from? It also looks at costs and what have we spent the money on. Now, there are various different categories that we have to show in our financial statements. So, for example, we have to show any dividends that we have paid out. We have to show any interest that we've paid out to the bank. So, it gives the users of the financial statements an idea of where the money came from and what we were trying to do with it. The statement of cash flows is basically looking at our sources of cash. So, for example, we can get cash from operating activities. When you guys do F3, if you haven't done it already, one of the things that you guys will obviously come across is the idea that you sell something for $10 and the cost of it is $6. So you make a profit, $4. Fairly obvious. But of course the other thing is you've got cash of $4 as well. So you received $10 cash, you paid out $6 cash, you've got $4 cash left over. So one of the big sources of cash is simply it's making a profit. Now, when you look at profit, there are other items that need to be adjusted. I fully accept that. But profits are a big source of cash. There are other ways that you can get cash. For example, to do with your working capital. Now, again, we're not going to go into it in too much detail. But if you decided to delay paying your payables, that would leave you with more money. You've got the money and you haven't paid it out. That's a source of cash. Similarly, if you were to collect your receivables more quickly, that is also a source of cash. We might have raised cash from borrowing. We might have raised cash through going to our shareholders. So the cash flow statement can tell us where did the cash come from and then what was it spent on. Did I buy non-current assets with it? Did I pay a dividend with it? Did I pay some interest with it? What exactly did I do with it? Now, there is an argument that says that that statement is actually the most useful out of all of them. Because as a business, you can carry on for a number of years making losses. But you can't carry on if you have no money. So cash flow, it gives us an idea of, does it look like the company is looking after its cash wisely? The statement of financial position. We are basically looking there at assets and at liabilities. We are looking there at saying, what do we own? Non-current assets, current assets. What do we owe? Current liabilities, non-current liabilities, debt, equity, etc. And again, it's an idea of saying, what have we done with our profits? What have we done with our cash? And is the company likely to survive? Particularly if your current liabilities, what you have to pay out fairly quickly, is about the same as your current assets, what you can collect quickly, you might have problems in the future. So current assets, what can you collect in quickly? Current liabilities, what's going to have to go out quickly? If they're fairly similar, you might well have a problem in the future. So all of these are useful in different ways.